Hello, everyone, and welcome to a new session with Rights and Responsibilities Awareness Initiative. Today, we're lucky again to have Megan Dislip and Ingrid Bird from Libro Credit Union to talk to us about the cost of home ownership. Thank you so much, Megan and Ingrid, for joining us today.
Yes, of course. You're welcome. Happy to be here again. So, thank you for taking the time to join us today to learn about the cost of home ownership. Special thank you to Heatham as well for having us. So, my name is Ingrid Parrott, and I'm a small business specialist with Libro Connect or Libro Credit Union. I'm joined today by my colleague Megan Dislip, an investment specialist also with Libro Credit Union. So we're here to present a session from Each One Teach One, a financial literacy initiative where certified trainers like ourselves visit communities to share valuable information. So the goal here is to help individuals make more informed financial decisions through education. Although we are representing Libro today, the session is not about promoting Libro's products or services. Instead, it's about equipping you with the knowledge you need to navigate financial decisions with confidence. So, just before we get started, I'd like to take a moment for a land acknowledgement. Um, we acknowledge that we are gathered on the traditional lands of the Anishinaabe, Haudenosaunee, Lenape, Mississauga, and Attawandaron peoples in the area governed by the London Township Treaty. We honor the enduring presence and deep traditional knowledge of the Indigenous peoples with whom we share this land. Now let's get started on our presentation today on the cost of home ownership.
So today we're going to be talking about the ongoing costs of owning a home, how a mortgage works, the different types of mortgages, how to save money on your mortgage, and much, much more. So before we get started, let's define what is the cost of home ownership. So it's important to understand both the upfront and ongoing costs, including your closing costs and mortgage. So we're going to go into, there's probably some new words in there of what all of that means. So before you buy a home, it's really important to look into how much can you afford. So the maximum home price that you can afford depends on several factors, including your household income, the size of your down payment, so how much you have saved for your home currently and in the future, the interest rate that you're going to pay on your mortgage, some personal preferences as well, and then two different terms, GDS and TDS, gross debt service ratio and total debt service ratio. And we're going to go in details of what that means too. And just a reminder as we're going through this, you don't have to spend the maximum amount that you can afford. So whatever you qualify for a mortgage and your down payment and your total home price doesn't mean that's what you have to spend on a home. And ideally, you're going to spend a little bit less to put yourself in a good financial situation.
So, how much can you afford? There's a couple of affordability rules that we'd like to present. So, number one would be that your housing costs should not be more than 35% of your gross monthly income. And the other is that your entire monthly debt load should not cost more than 42% of your gross monthly income. So, two key rules to keep in mind here. So there is sorry, I just have to move my screen. So here, um, here we go. Here's our breakdown for the affordability rule number one. So this is the gross debt servicing ratio that Megan was speaking about. So housing should not cost more than 32% of your gross monthly income. So we would take your total monthly housing costs and divide them by your gross monthly income, times that by 10, or by 100, sorry, would equal the gross debt service ratio. So the amount here should be less than 35%. If it exceeds 39% of your housing costs may be too high. So 13. And then when it comes to the affordability rule number 2, this is the total debt service ratio. So the debt load that you have should not be more than 42% of your gross income. So how we calculate this would be to take all of your housing costs plus your total monthly debt obligations, divide that by your gross income, and then times that by 100 would equal the total debt service ratio. So if this exceeds 44% of your housing costs, it may be too high.
Next, let's talk about other costs of buying a home. So there's more costs involved in a home sale than just that upfront purchase price. So as part of buying a home, you have purchase and sales costs. If you're selling a previous home, you're going to have realtor fees that go along with that likely. And then you also have closing costs on a home, other costs such as GST and other taxes, and then your ongoing costs of maintaining and operating that home. So what entails purchase and sales costs? So this can include your down payment that you're going to put your savings towards your house, possibly a property appraisal, a survey, a home inspection. If you have to get mortgage insurance, which we'll go into depth later on, CMHC is a popular mortgage insurance, and their premiums and application fees, and then as well as real estate fees. So it's a lot more than just your mortgage and your down payment when you're looking at buying a home. And then there's also closing costs involved. So closing costs can include land transfer taxes, legal fees, setting up home insurance and title insurance, moving expenses, and any urgent repairs that's required as well to make that home livable. And other costs to consider if you're purchasing a new home, there could be GST expenses, property transfer taxes, any other legal fees and disbursements, property related adjustments, and then appliances and furniture for your new place. Still me? Okay. So then ongoing costs for your home as well. So these are going to be regular, like monthly expenses that you have to consider. Property taxes, property insurance, fire insurance, utilities, and maintenance and repair. And maintenance and repair can add up very quickly.
So understanding your mortgage. So this is a loan that you have with a financial institution to purchase a property. So as a home buyer, it's important to understand how the mortgage works. So some key terms here would be amortization period, interest rate type, payment schedule, and terms. And we're going to break those down. So understanding the amortization period. So the amortization period is the length of time you pay off your mortgage. So typically you'll see 25 or 30 years. The longer amortization equals smaller monthly payments. So typically we stretch that out so we have smaller payments, biweekly or monthly, however you choose to pay your mortgage. The longer the amortization, it would equal to higher interest costs. So just something to keep in mind. Understanding your mortgage interest rate. So this is the amount the lender charges you to borrow money from them. This is the percentage of the amount borrowed. So some types of interest rate are fixed, variable, and interest only. Although interest only, I don't see very often. So I'd say fixed and variable are the more common ones.
So now we're going to talk about fixed versus variable rate mortgages. So with a fixed rate, you have a predictable interest rate and a predictable payment schedule. So your interest rate and your payment schedule stay the same for the term of your mortgage. You can finance up to 95% of the value of your home on fixed and variable. So I'm going to keep math really simple. If your home was worth $100,000, then you could finance up to $95,000 to hold in a mortgage. Fixed rates have open terms or fixed terms between 6 months and 10 years. And you can amortize up to 25 or 30 years, depending on your situation. With a variable rate, your interest rate can change at any time with fixed monthly payments. You still have a predictable payment schedule, and you can do an open term or a fixed term of 5 years. If interest rates start to rise, you can also convert to a fixed term mortgage. And then again, you can amortize up to 25 or 30 years, depending on your situation.
So let's dive into the mortgage payment schedule. So there's a few ways that we can set the mortgage up for this. We could do monthly payments, so that would be 12 payments per year. We could do semi-monthly, which is 2 payments per month, so that would be 24 payments. Bi-weekly, which would be monthly payment times 12 divided by 26. So bi-weekly is 26. Accelerated biweekly, 26 payments there. And then you can also do a weekly. So that would be the monthly payment times 12 divided by 52, or the accelerated weekly. So 52 payments. So when it comes to the CMHC, that stands for the Canadian Mortgage and Housing Corporation. There are several easy to use mortgage tools on their website. We've got a link here. I know it's a little bit to try to copy this down, but maybe a quick Google search could get you to this link easier. But some of these tools include your debt service, household budget, premium, so your mortgage premium, mortgage payment, and mortgage affordability. So these are really great tools to access when you are looking to purchase a home to see how that looks for you and your situation. And then a few of the mortgage types. So I know that Megan already touched upon a few of these. So open term, fixed term, and high ratio.
So now let's go in depth on what these mortgage types mean. So an open term mortgage allows you to make payments ahead of schedule without paying a penalty. So if you got a raise at work or a bonus or any unexpected money, you could just apply extra money to your mortgage without paying any penalties. You can choose a term between 6 months to 5 years with either a fixed or variable rate, and then you can repay any portion of your loan at any time. You can you pay no penalty for these earlier extra payments, and you also pay no penalty for converting to another mortgage type early. So it gives you a lot of flexibility with an open term. With a fixed term, interest rates are typically lower, but if you make extra payments, depending on every financial institution has different rules on what you can do for extra payments. And then if you want to pay beyond those rules, then you must pay a penalty to make those extra payments. It offers a term between 6 months and 10 years with either a fixed or variable rate. You can enjoy that predictable payment schedule. And typically it's a lower interest rate than an open term mortgage, but you have to agree to commit to the full term of the mortgage. So if you sign up for a 5-year fixed term is very popular, and you want to go beyond payments of that term, or you want to change your term early, then you have to pay a penalty. Next, we'll talk about high ratio. So a high ratio mortgage is if your down payment is less than 20% of the property value. So you're going to be borrowing more than 80% of what your home is worth. Because of this, mortgage default insurance is required in order to get a mortgage. It's a one-time cost that's either payable upfront or added to your mortgage balance. And the amount is dependent on your mortgage amount and your down payment. If you are getting a high ratio mortgage, then your amortization has to be 25 years or less. The mortgage stress test was made mandatory in January of 2018 for all mortgages. This stress test is in place to ensure that if interest rates change and they increase, that everyone's still able to afford their mortgage payments. So it's mandatory for all high ratio mortgages that are insured. The mortgage high ratio loan insurance protects lenders against default. So that's where if they're going to be financing more than 80% of your home's value, you have to have this insurance in place for your lender, for your lender's protection. So you're able to purchase a home with a minimum down payment of at least 5%. And the more that you put towards your home total, then the more that you save for a down payment and are able to increase the percentage you put down on your home, then the less that you'll pay in insurance premiums. So how to save some money on your mortgage. So if you have a mortgage currently and you're looking to save money overall, you can increase your payment frequency. You can shorten your amortization period. So instead of having a mortgage for 20 or 25 years, trying to make that even 18 or 22 years, taking a couple years off makes a big difference. Increase your regular payment if you're paying $1,000 a month on your mortgage. If it's allowed in the terms of your mortgage, could you increase that to $1,100 a month? Choosing a mortgage with a prepayment option. Investing your tax refund and cash windfalls into your mortgage as extra payments if allowed, and then keeping your payments high.
I'm so sorry. The sun is doing funny things to my office today. So just a recap of what we've covered today. It was quite in depth. So the ongoing costs of owning a home, how a mortgage works, different types of mortgages, how to save on your mortgage, and a little bit more. Are there any questions?
Thank you so much, Megan and Ingrid, for this fruitful presentation. I've got only one question. Can I, as a customer or client, negotiate the mortgage terms? Are they subject to negotiation? Is there anything I can bargain with, if I may use that term?
Did you want to take this one, Megan?
Sure. I would say it depends on your financial institution. So it's definitely worth a conversation with a mortgage specialist or a lending specialist at your financial institution to talk about any negotiation terms that you want to have, whether that's based on term or rate or prepayment options, to see the rules are different at every institution. Do you have anything to add there, Ingrid?
Um, I think that was a pretty great answer. Just a little bit more around that. You would be able to, lessen your mortgage if you were putting more funds down towards that loan upfront. Um, it's not exactly negotiation, but it could help with getting a better rate in the end because you're paying less interest on um, less of an amount of funds. So yeah, it's best to speak with your financial institution to see what they could offer for sure, and then go from there.
Thank you so much for this, and thank you everyone for joining us at the end of this session. I would like to express my thanks to Megan and Ingrid, and of course to Libro Credit Union for their ongoing support. Thank you so much for being here today.
Thank you for having us.
Of course. And for everyone, thank you for joining us. Stay well, stay safe, and we are looking forward to see you at another session with Rights